Hello friends, last week in my video, I put forth my concerns about banking that could drag the markets. Because with almost 36% weightage in the Nifty, banking and financial sector stocks are quite simply the largest segment weighted in the Nifty as a standalone sector. And the bank and financial sector stocks were volatile, and but for which the indices and values would have been significantly higher last week. I've updated you about the RBI governor warning us about exuberance in lending activities, especially to retail personal loan segment, NBFCs, and credit card outstandings. He's actually gone ahead and used the word contagion for the first time, expressing concerns about banking. But the market seemed to be kind of unperturbed and brushing off these worries and proceeding to business as normal. The war in Gaza has also been discounted, which I have been telling you from the fact that oil and gas markets seem to be falling and there are no worries about the war spreading to other areas. And I've been updating my views in detail on our free Telegram channel, and the fallout of Argentina is coming to fruition exactly along expected lines. Do connect with me there and share where I share my ideas and thoughts in detailed editorials. Now, let's get down to the basics, and coming up on your screen is the market roundup window, where we see that the bank Nifty rose marginally higher than the Nifty 50 on short covering, and the US dollar index, the DXY, continued its decline, and that kind of boosted bullion and kind of pushed gold and silver prices higher. Oil was also marginally higher, but then there is an upcoming meeting of OPEC Plus, where it is expected that OPEC might just cut output to stabilize prices. We'll know soon enough. I'll update you on our free Telegram channel. Crude natural gas prices fell, and that's not really too much of a surprise, because I've been telling you that it was going up in spite of full storage tanks in Europe and elsewhere. It was just the cyclicality of pre-winter panic in the markets that had pushed up prices. I do expect prices to remain kind of brittle. The USD INR rose, which is the rupee weakened against the US dollar. And we are now at all-time lows against the dollar. That could basically be a slight concern. The Indian 10-year benchmark bond yields rose 7 basis points to 7.28, which means bond prices fell. Had it not been for falling bond prices, the bank Nifty could have been even higher. NSE market capitalization rose by 1/3 of a percentage point, which tells you that the rally was somewhat broad-based but relatively mild. MWPL went up routinely, but I think it has already reached a peak. The coming week is an expiry week, and therefore you're unlikely to see a major spike. US indices were uniformly higher, that provided tailwinds to our domestic markets. Friends, I now come to our in-house indicators, starting with the MWPL, which is now at its highest at 39.02. It's at the highest after the August peak reached at 39.27. So is it going to reach 40%? It might just reach 40%, but close below it, because Thursday is expiry, as you know, and thereafter there will be a routine post-expiry decline. Nevertheless, risk appetite went up. Friends, I now come to the index and stock futures turnover of 3 concurrent series, which is November, December, and January. Volumes seem to have gone up. The reason why I'm using the word seem to, because last week was a full 5 trading session week, whereas the prior week was a 4 trading session week. So volumes were naturally going to be higher. Now for the NSE advanced decline ratio, which actually fell on a week-on-week basis in spite of the fact that the markets went up. So the NSE advanced decline ratio at 0.96 tells you that for every 100 losers, there were only 96 gainers. Buying conviction was lower last week. This is the average of all 5 trading sessions of the week gone by. Friends, I now come to the prompt futures basis. Basis is nothing but the premium or discount prevalent in the futures compared to the spot. Both the indices witnessed a very sharp kind of compression in basis, which tells me that risk appetite fell in the market. Of course, the closer you get to expiry, the lower is the premium because traders have fewer days to play along with. But as long as basis is not inverted, which means the futures are not trading at a discount to cash, I think bulls still have a chance. Friends, I now come to our in-house indicator, the impetus, which you've trusted for 2.5 years or longer. And what you are seeing is that the Nifty impetus fell, whereas the Bank Nifty impetus rose. That means the buying was rather relatively forceful in Bank Nifty and it lacked momentum in the Nifty 50. The fact that the broader of the two indices lacked buying momentum tells you that volatility might just rise. Do remember, the coming week is shorter by one trading session. I now come to lift, weight, thrust, drag index. And this is another index that you've been in-house study exclusively to our in-house statistical trading models that you've been trusting for over 2 years now. And what you are seeing is that the Nifty has notched up gains of 0.32%, but the LWTD has shrunk. It has fallen. Although it remains above zero, but the fact remains that fresh buying support may be rather mild. There is ample reason to believe why, because the coming week is an expiry one and traders are likely to focus more on rolling over or squaring up their trades rather than lending excessive fresh buying support, that too in a week which has only 4 trading sessions. Friends, our in-house indicators done. I now come to the bond market where the Indian 10-year benchmark bond yield kind of rose by 7 basis points. What does it tell you? That the upcoming RBI Monetary Policy Committee meeting in December is eagerly awaited by bankers. They are trying to second guess which way the interest rates might go. And what we are seeing on the weekly chart of the Indian 10-year benchmark bond yields is that the bullish candle made last week is coming after 4 consecutive bearish candles. But the bullish candle itself is contained within the previous week's candle. So it's an inside day formation, or rather an inside week formation. And we are still not into a decisive zone above 7.5, 7.60, where I would start laddering bond yields. Nor are we below the 7.05 or 7.00 levels, where I would recommend that you buy gilt funds. So what are we doing? I suggest, or at least I am personally, sitting on the fence, keeping the powder dry, keeping my checkbook ready, and not deploying money anywhere at all. Friends, the bond market's done. I now come to the Bank Nifty, which has gained 0.42%. As you can see on the daily chart on your screen, it has risen on 4 out of 5 trading sessions last week and managed to close above the month-long moving average, which itself is going sideways. The price is below the head and shoulders neckline formation, which is plotted as a slanting blue line. And as long as the price remains below this neckline, I think bulls will still need to push harder in order to trigger a fresh buying phase in the markets. The upcoming RBI monetary policy meeting will be watched with anticipation. The Bank Nifty continues to remain an underperformer as compared to the Nifty 50, as you can see in the inset box on your screen. And now coming to the weekly chart, what we are seeing is a small bullish candle, a small bullish hammer, which indicates the bears attempted to push the index lower but failed to hold it down. The price is below its 25-week exponential moving average, which is a 6-month long holding on cost of an average bull, and that too for the 6th week in a row. That means the medium term outlook is nervous for now. Only a sustained trade above the 44,152 level is likely to trigger a fresh round of buying, which will be a breakout. And await that breakout before you can contemplate buying afresh. Friends, in the week before last, this index was number 5 on the list of our most volatile counters based on statistical beta rankings we maintain in-house. It remained there at number 5, so status quo maintained. Last week, I advocated an estimated range between 44,675 on the upside and 42,500 on the downside, which held perfectly well because the week was frankly a very narrow range week. In the coming week, I estimate a range between 44,800 on the upside and 42,725 on the downside due to the low base effect of last week's range. Do refer to our daily, weekly, and monthly index pivots on our free Telegram channel. It will help you as a trader in the futures and options segment, both swing and intraday basis. Friends, the Bank Nifty done. I now come to the Nifty 50, which gained 0.32% on a week-on-week basis, and it rose on 2 out of 5 trading sessions, as you can see on the daily chart on your screen. The price remained above its month-long moving average, which is itself rising higher. So relatively speaking, the Nifty is stronger than the Bank Nifty, even as the relative return comparison shows you in the inset box below. The weekly chart on your screen shows a smaller bullish candle, the 4th one in a row. The 19,875 level, which I advocated last week as a breakout level to watch out for, was tested, but a breakout did not occur. So the 19,875 level remains as a level to watch out for. Only a sustained trade above that will put bulls back in the driver's seat. And if at all this breakout occurs, it may trigger a dual pressure phenomena. A dual pressure phenomena is when both the bulls are buying and the bears are covering in panic. That means double pressure on prices. Depending on your feedback, whether you want me to explain these terms in a separate podcast, I could record a podcast on this at a later date. The price is above a 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. And that too comfortably so for the 4th week in a row. So the medium-term outlook is positive for now. Friends, in the week before last, this index was number 10 on our most volatile counters list based on statistical beta rankings we maintain in-house. It rose 1 notch to number 10, which means volatility rose up a bit. Last week, I advocated an estimated range between 20,125 on the upside and 19,350 on the downside, which held perfectly well. In the coming week, the estimated range is between 20,175 on the upside and 19,425 on the downside. This is due to the relatively smaller base effect of last week's range. Do refer to our daily, weekly, and monthly pivots on our free Telegram channel. It will help you as a short-term, intraday, and swing trader, both in the options and futures segment. Friends, I now come to the last bit of statistical analysis wherein I analyze the retail risk appetite depending on their contribution in the turnover on the 4 segments of the derivatives market. On your screen right now is the daily chart, 20-week chart rather, of index futures, which is indicated as a blue line where the contribution went down marginally, and stock futures, which are shown as a red line, where contribution went up smartly. Where stock options are concerned, they are shown as a purple line where the contribution fell. Where index options are concerned, they are shown as an army green line where again the contribution fell. The fact that contribution rose in the stock a future segment, which is the riskiest, most volatile, and highest capital intensive, where you need the largest amount of money in span and exposure margins, tells you that traders were willing to pump in money and therefore risk appetite was higher. Friends, I now come to sharing my strategy and blueprint in the week ahead. And oil and gas is likely to remain under pressure with, of course, bouts of volatility. So I would continue with my theta decay strategy in the option segment to capitalize on earning premiums. And interest rate sensitives in the stock market will also remain on our theta decay list. Metal stocks might remain firm as long as metal prices are bullish on commodity exchanges. And if oil prices continue to fall sharply, oil marketing company stocks might just receive buying support at lower levels. PSUs will also remain in the limelight. By PSUs, I mean public sector undertakings. And the week is shorter by a day on Monday, so traded volumes might just be lower. That means I'm also going to trade light. The USD INR, which is the dollar versus the rupee, continues to remain a mild caution for me because the rupee continues to weaken against the dollar. And the coming week is likely to see OPEC's meeting, which may trigger a temporary rise in the prices of oil and maybe even gas. But I wouldn't really worry about it. I remain of the opinion that a super cycle in oil and gas is a misinformed and incorrectly formulated hypothesis, mathematically and statistically speaking. Friends, before I sign off from this video, a reminder to subscribe to my YouTube channel if you haven't already done so. In the comment segment, do let me know what you think about our work and how it helps you become better traders. Also, help me reach out to fellow like-minded smart traders like yourselves by sharing my video with your family and friends. I thank you for your patience in being with me in this video till we meet again in my next. This is Vijay Bhambwani signing off for now. Wish you a very, very happy Guru Nanak Jayanti in advance. All the best.